So I'm going to talk through the biggest changes to personal and business taxation that the Chancellor announced yesterday, starting with changes to income tax and national insurance thresholds. Now, the thresholds for income tax and employee national insurance are already being frozen for 4 years. Yesterday, that was extended for a further 2 years, along with extensions to various other freezes to thresholds. Until now, the threshold for employers' national insurance hadn't been frozen. That's now being frozen until the same point as well. And the Chancellor reduced the point at which you start paying the 45% additional rate of income tax from £150,000 to £125,140. The reason for that specific number is because once your income exceeds £100,000, your personal allowance gets withdrawn, creating an effective 60% income tax band above £100,000. £125,140 is where that tax band ends, so you'll now go straight from that into the 45% band. And that final change will increase the number of additional rate taxpayers by about £350,000. So just the increase from yesterday's announcement is more than the total number of additional rate taxpayers that there were when the additional rate was first introduced. And this just is coming on top of a long line of freezes. Now, it's now the case that essentially every significant threshold in the income tax and national insurance system is being frozen over a long time horizon. Now, that's just not a sensible way to make policy. It means that the size of the tax rise depends hugely on what inflation turns out to be. It's an accidental and arbitrary outcome of that, rather than being the result of a deliberate policy choice. So just to take an example, the original 4-year freeze to income tax thresholds had been due to raise £8 billion when it was first announced. By the summer, we thought that was on course to raise more like £30 billion, almost 4 times as much. Inflation expectations are now a bit lower, so that's now down to £24 billion, although there are now additional freezes on top. You can see it just goes up and down according to what inflation turns out to be, and clearly we can have no idea what that'll be 3 or 4 years down the line. So what do these changes mean for people's incomes? So this shows how people's net take-home pay after tax will change according to their level of earnings. And this first yellow line shows what it looked like before the autumn statement, the changes that we already knew about. If we add in the changes that were announced yesterday, you see the tax rises for pretty much all income levels have got bigger. Again, depends a lot on what inflation turns out to be, but maybe £180, £200 more in tax per year for most taxpayers, something more like £1,500 more tax per year for those above £150,000 a year. But bear in mind, that's not necessarily a bigger percentage of their income. So this long period of freezing thresholds, particularly when inflation is so high, will obviously increase the number of taxpayers and the number of people in higher tax bands. So this shows how the number of higher and additional rate taxpayers has changed over the years. By the end of these freezes, we reckon almost 15% of the adult population will be paying higher rate tax. That's up from 8% just a couple of years ago, and under 4% 1990 when individual taxation was first introduced. And there'll actually be 2 million people just above the £100,000 threshold and therefore facing 45% or 60% marginal rates of income tax, and more people above the £100,000 threshold than there were higher rate taxpayers in total in 1990. Turning to council tax, the Chancellor announced that councils would be allowed to increase their council tax by up to 5% a year for the next 5 years. That's up from a limit of 3% this year. The OBR reckons that by the end of the 5 years, that'll be raising almost £5 billion a year more for councils. Now, that's assuming that councils essentially take up their freedom to increase council tax rates in full. This chart shows that if they do that, rather than, say, increasing it by 3% a year, that would increase council tax bills by about £160 a year on average, and would leave us on course to have the highest ever real terms council tax bills. Now, actually, that might not be that surprising. We might expect council tax to rise in real terms. We might expect it to keep pace with incomes, say, or keep pace with house prices, not that incomes are rising that much at the moment. But the underlying point here, the bigger point, is that this is essentially an increase in an unreformed tax. Council tax remains regressive, distortionary, and above all, still based on hopelessly out-of-date property values. In contrast, business rates is being brought up to date from next April. It'll be based on 2021 property values rather than 2015 values. That's a very good thing. The government is devoting £1.7 billion to ensure that those whose tax bills go up as a result of having their property revalued will see the bills rise only gradually, whereas those whose bills would fall can see it fall immediately. The Chancellor also announced two other cuts to business rates. It wasn't just a tax-raising autumn statement yesterday. First was a 6% real-term cut to business rates across the board. So if I show you now, the tax payable as a percentage of property value, it reduces it from this light green line to the darker line. So for a typical business with a rateable value of, say, £20,000 or £30,000, that'll be worth a few £100s a year off their business rates bill. The other cut to business rates was more specific. It was a 75% reduction for retail, hospitality and leisure businesses for 1 year only. So that one will be worth more like thousands of pounds rather than hundreds of pounds for a typical qualifying business. Now, that's supposed to be for 1 year only. It's coming on the back of a history of a series of other reliefs like this, but actually it's even more generous than the 50% relief that this sector is getting at the moment, which was supposed to be a temporary thing to help with the tail end and the aftermath of the pandemic. It's quite hard to see what the for another huge, even bigger relief for retail for 1 year only. But given the history of this, it must be doubtful whether it really will be for 1 year only. And the more people believe that this is going to be permanent or keep being repeated, the less effective it'll be at supporting the sector, because the more we'll tend to see rents on these properties increase so that it benefits landlords rather than the retailers themselves. Again, the broader point with business rates here is that it looks like the government doesn't much like business rates and the effects that it has, but it doesn't quite know what to do about it. It had a fundamental review of business rates, but it didn't lead to fundamental reform. Yesterday, they confirmed they wouldn't be going ahead with a move to an online sales tax, which I think is very good that they're not doing that. But they just seem to be responding by saying, well, we'll have ad hoc reductions and adjustments to business rates here and there, whenever we think it's needed or suitable. That's not really an adequate solution. We need a better vision for what business rates should be doing. The other big announcement on business taxation was, of course, extensions to the windfall tax on the energy sector. So this shows, first of all, the standard rate of corporation tax in the UK and how it's changed over time. Profits from North Sea oil and gas have always been subject to higher tax rates than this. The energy profits levy that was announced in May said that rather than the tax rate for profits from oil and gas continuing at that level, it would go up to an effective rate of 65% for up to 3.5 years. Yesterday, the Chancellor announced that the rate would be higher and that it would last for longer. And this almost doubled the revenue that he expects to get from it. Of course, again, very uncertain, depends on what happens to oil and gas prices and therefore the profits from these companies. This is a pretty substantial, if temporary, tax increase. They're really just taking tax rates on oil and gas profits to around the levels that they've been for, well, much of the previous 40 or 50 years. The windfall tax was also extended in another way, as well as increasing it for North Sea oil and gas producers. There was a new windfall tax on low carbon electricity generators, which again, the Chancellor expects to raise a fairly substantial £14 billion over the 5 years or so that it's in place. Now, the government's been thinking for a while about how exactly to do this, and this replaces an earlier plan that they had. We think this looks like quite a reasonable way to tax the windfalls that these companies are receiving if you decide you want a windfall tax on these profits. There are also a series of smaller tax reforms that I won't spend much time on. There was a common theme to them of really missed opportunities here. There was a reversal of the cut to stamp duty announced in the mini budget, which I think is a bit of a shame. Of all of the tax cuts in the mini budget, that was one that I would like to have seen kept, at least the broad brush reduction. There was the introduction of vehicle excise duty for electric vehicles. Now, the government badly needs a strategy, a plan for how it's going to tax electric vehicles in the future. Just putting vehicle excise duty on them is not a good plan for how you want to tax them in the long term. And the Chancellor slashed the allowances, the amount of dividends and capital gains that you can receive tax-free. Now, capital gains tax in particular is badly in need of reform. You can argue for or against cutting the allowances, but I think what I would say fairly safely is that it wouldn't have been near the top of my list of reforms that we need to capital gains tax. Everything from the reliefs of business asset disposal relief to allowing for inflation to the way that it operates at death would be high priorities. So to sum up, this was a substantially, although not enormously, tax-raising autumn statement. Some of the biggest tax rises, of course, were only temporary, and there was at least one significant tax cut in amongst the general theme of tax rises. But overall, the Chancellor has broadly opted for a set of what looked like relatively easy revenue raises rather than much needed coherent reform of the system. Simply announcing freezes to thresholds in future years when you've got very little idea of how big a tax rise that'll turn out to be is not a good way to make policy. And then areas like the taxation of property, whether that's business rates, council tax, stamp duty, how we should tax electric vehicles, how we should tax capital gains, these are all areas that need serious thought and well-considered reform. Now, to be fair, the Chancellor is new in post and had only a few weeks to prepare a budget in what was almost emergency circumstances. So I think I might cut him a bit of slack on this occasion, but I would say I would hope for some more considered reform when the Chancellor has a bit longer to think about the issues and bring forward his plans. At that point, I will stop and hand over to Xiao Wei.